Hello, everyone. Good evening and good afternoon. Good morning to Indian people. And I welcome you all to our show, Business Talk, which we do every Wednesday, same time. Today, we will be learning from our top experienced expert who are in the field of finance, and we'll be learning about wealth management and financial investment and proper planning during this unprecedented time. And we'll be learning on both US and India markets. So today we have the opportunity to have three brilliant guys on our show, Mr. Srini Meka, Mr. Narayan Dake, and Mr. Yogesh Bihani. So I would introduce first Mr. Srini Meka. So Mr. Srini Meka is a Tennessee State registered financial advisor. Srini has 25 years of investment experience in stocks and derivatives. For the past 10 years, Srini has been managing value portfolio at Interactive Advisors. His financial articles featured at several websites, including Yahoo Finance, Street.com, Fox Business News, Seeking Alpha, and the Wall Street Journal. Srini holds a master's degree in mechanical engineering from the University of Texas at El Paso and an MBA in finance from the University of Memphis and a CFA charter holder. Welcome, Srini, in our show.
Thank you, Arpita. Thank you for a wonderful introduction. Really appreciate it.
Thank you, thank you. And our next guest is Mr. Narayan Dake, who is practicing chartered accountant located at Pune, India. And he's having 6 years of post-qualification experience in the field of audits under Companies Act, Income Tax Act, VAT, and GST Act. Also, he has provided compliance-related consultancies under various acts. He's on RBI's approved panel of statutory bank branch auditors, also working in association with various CA firms in Pune. So welcome, Mr. Narayan Dake, in our show today.
Thanks, Arpita, for such a wonderful introduction.
Thank you. Thank you. And we are glad to have you here.
Yeah, thanks. Thanks for...
Thank you. Thank you. And now I would introduce my co-host, Mr. Arijit Basu. He is a senior data analyst working with the leading hospitals in Memphis. And Arijit, over to you.
Thank you, Arpita. Thank you so much for the nice introduction. And good morning, viewers all around India and other parts of Asia. And good evening to our viewers in US and various other parts of the world. There might be in the midnight. Or I welcome our three guests tonight for our one of the most important shows. And it's very interesting as well. It would be interesting because we want to know more about investments and what investments. Yes, that is the prime thing for all of us. Before I go into details about our other guests tonight, stay with us. We are from nrbnews24.com. We are welcoming all of you, all our guests. Please post your comments, like our page, and keep watching it and share our videos whenever you want to. Now I have with me Yogesh. Hello.
Hello.
Yeah, can you hear me?
Yeah, I can hear you.
Okay. So to talk about Yogesh is from
Ahmednagar district.
Yeah, you are Yogesh born and brought up at Luni, a town near Holy Place at Sai Baba Shirdi. He's a founder of Future Plus Financial Services Private Limited. He has been in this field for almost 14 years in the area of investment advisory, wealth management. He started from insurance sector. Then he quickly realized the importance of mutual funds and equities. Then he entered into mutual fund businesses in 2006 and equities in 2012. He's a certified financial planner registered with the Financial Planning Standards Board India. He completed his CFP certification in 2010. He has done MBA in finance from Sikkim Manipal University, Pune, and in Bachelor in Commerce from Pune University. Also holds a diploma in mechanical engineering. He's also managing investments of approximately 600 retail clients and 10 cooperative credit societies and 5 cooperative banks. He conducted about 20 investor awareness programs with Doctors Association and businessmen. I welcome you to this show.
Thank you,
Yogesh.
Arijit.
Thank you so much. Thank you to all our guests. Now, I would like to go back to our host, our guest, Mr. Srini Meka. Now that Srini, you are from USA, so we have been I keenly follow the US market. So, but there are several things which we would be interested to know, and our guests would be audience would like to know. So, you have such a varied profile. Would like to know about your journey until now with a career spanning over 25 years. So, it's over to you, Srini.
Oh, thank you. Good morning, India. Good morning, good evening, North America. As I said, my journey started like in 1991, late 91. Came for a master's degree in mechanical engineering. But namesake, I was a mechanical engineer. But those days, there were plenty of opportunities in computers. If you know a little bit about programming, you get a job, and you're getting a lot more than an engineer can make. So I learned Access a couple of days. I applied for a job. Believe me or not, the third day they called me for a job interview, and they said that, okay, you can do it. I said, okay, I will do it. I started like that, and I was since the day I started making money, like in college days, it's a lot of struggle. A lot of people go through the same thing, and you got to work hard and pay the tuition and all that good stuff. But basically, I lived not really good life, tough life. But I decided, no matter what, the reason I came to US is to not only this intellectual capital you wanted to learn, but I wanted to grow myself both financially, and I started learning self-learner. In the 90s, I've been working in IT industry. I worked in Minneapolis, and I worked for a couple of big five firms and those now. Now it's a big four: Ernst & Young and Deloitte and Touche. I worked at senior levels, and later I worked for Sharing-Plough, which is part of Merck, until 2014. While I was in Big Four, I interacted with a lot of corporate executives, CEOs, those kind of people at the higher level. I was really impressed with their acumen about the numbers and the financial figures and the strategic look they have. So I kind of, so in 90s, I made real good money, all the bubble boom and in e-commerce time. That's the browser came in 1994. Of course, internet there since 1960s, but the browser changed the things. It opened up a lot of things, and also the mania came. Anything.com, the prices used to go high, and just like a lot of people, I made really good money. I used to double money in 1 week. It's kind of dumb luck, I just made money, and I blew up everything in 2000. And I realized this is not the way I should be doing the things. And I wanted to learn from ground level. So I started learning finance and accounting with no background in accounting. I mean, I thought, if I have no background in computer science and I survived and thrived, why can't I learn the day-to-day stuff? That's the reason I started getting into real value investing and all that. and drawing the fundamentals like financial numbers and how to analyze the numbers and where is it truly worth the dollar, as a dollar is trading at 10 cents. So if it is a dime worth the dollar, then I could buy. So I took my MBA in finance in UFM. Then I started get to know about CFA. I thought it's too easy. I got all straight A's, 4.0 in MBA. I thought I can kill it. Actually, CFA killed me. That's the reason very few people get CFA chartered. No wonder. I'm not bragging, but man, if you wanted to do CFA, think twice. You got to be single, not married, and you have a family left. Don't give it. Is it worth it? I don't know. But you learn a lot. But by all means, it's a tough one. That's the way I started, and I've been investing since then. I learned how to multiply the, so if you have a discipline and consistency, we'll discuss about that. And that's the where you make good returns. Even an average person can make extraordinary returns if you have persistency and consistency. And we can discuss about those things later. But I've been managing a portfolio at Interactive Brokers. I was bragging about, my returns are this good, that good. And somebody said, show me the proof. What's the proof? I said, what do I do? You got to audit. I said, give me one more reason. They said, can you put a public portfolio? That's what I started with the Covester 10 years back. And then it's been acquired by the Interactive Brokers. It's a global company. And I've been managing that portfolio, value portfolio, since 2010. It's 10 years now. And at one point I thought, okay, I'm confident I can survive with what I have. I wanted to start my own, what I really like to do. That's the reason I got into portfolio management, like a wealth management business. Briefly, that's what I am there.
Srini, now that you said from a background of mechanical engineering to CFA, hats off, man.
Okay.
And I'm just waiting.
Because when I was reading your profile, even I was wondering how come mechanical engineer to a financial advisor. I mean, it's amazing.
Incredible, Jali, and I'm just waiting for this pandemic to be. And I'm just waiting for this pandemic to be over so that I can meet you and get the investment plan. How to double the money. Okay. So I'm sure now that we are into the question answer mode, the next question would be, as a financial advisor, how do you think about the importance of financial planning, and what are the current scenario in the US market?
Yeah, it's a global. America is not isolated. It's the global market. Most of our money, for our multinational, our companies are multinational. I think more than 50 to 60% of our revenue comes from outside US. Believe me or not, we are 35% of the global GDP is from US. So it's coming from most of the revenue coming from outside. So we're global. Having said that, if America sneezes, rest of the world gets cold. That's the thing. So having said that, financial planning, the reason for financial planning is there are a lot you don't know not things go as you want it to. You have to have a plan for anything. Even you wanted to build a pyramid, they had a plans before they built the pyramid. Same thing. This is everything, like, you may have the job issues, you may have the health issues, and how you address, the bird in the hand is two in the bush. When you are young, when you can manage things, you got to plan for your future. That's what is the financial planning about. So you need to look into what and all the options I have, how much I make at this point, and it's all the discipline. That's the planning about the wills, trusts, and those are the things I wanted to mention, because your audience are mixed, both US and India. In India, I assume in Bangladesh too, if your father's assets is like, you have a son and daughter, your father had, let's say, $1 million, like both kids get like 50-50, $500,000. It's by default, without any paper written on the paper, money flows from parents to kids. But in US, it doesn't work that way. The big point you need to know is having a will. In India, it's an optional, but in America, will is a must. Without that, then your assets will be probate, go through the probate process. That means government take over your assets, and they decide, do you have any other kids, do you have any other spouses, do you have any debts, those things. They do all that, and then the money flow through. In the meantime, the process takes 5 to 10% of your wealth is spent for the government lawyers and legal processes. So one, you need to have the will. That's a part of the financial plan. And second thing is a trust. People think only wealthy people needs the trust, but not necessarily. The trust is, it contains all your assets in one basket, and it is governed by the will, what you want it to. So that by having your assets in a trust, your assets never ever go through the probate process, because it's the part of the trust. The trustees get the assets automatically after you. So those are the two things, important things. You get the big difference between India and US. People come to US, a lot of people, they don't know what is behind, what is going on. So those are the things. And the next thing, you need to plan for longevity and inflation. And your assets may not last until you die. Your assets may not be enough until you pass away or pass it to your next generation. So that's the one thing. Second biggest challenge is the inflation. In US, we have 1%, 2% inflation for past 4 or 5 years. But in 80s, the inflation used to be in double digits, just like India or developing countries. I'm not blaming, I'm from India, but the thing is, the inflation is high at the developing countries, like 9%, 10%. If there is 9% inflation, means your wealth will be half in 8 years. Suppose if you buy a cup of coffee for 10 rupees, in 80 years, it would be 20 rupees, because 9%, 72, rule of 72. Same thing in United States. If something costs you $10, in 30 years, it would be $20. So because our inflation is supposed to be less, but still inflation is something drags you down. So you got to plan for inflation, longevity, and the health. So that's the major important features in the financial planning, irrespective where you are globally. But I focus mostly in US. The other Narayan and both of them, they talk about the Indian perspective, but a lot of things are global. I'm glad we got all three.
Thank you, Srini. It's a wonderful conversation we started with you. And the key to this, what I felt from this answer is the inflation, the longevity, and the health are the three key things that is required for a best spend planning. Over to you, Arpita. If you can ask.
You're mute.
Sorry. Over to you. So you can ask one more question to Srini before we move to Narayan.
Yes. So my next question to you, Srini, would be, what is the best way to plan for wealth management and build a secure future with proper investment? And what are those?
Yeah. First of all, if you are a young professional, the best thing you could do is start with an emergency fund and have some emergency fund that will cover at least 3 to 6 months of money. That's the first essential thing you wanted to do. And the second thing you wanted to do is, if you are working, most of the employers, they have the retirement plans such as 401k, 403b, 457, those kind of things. Those kind of things, what happens is government also encourages people to save, savers. So that way, what happens is, if you put your money into IRA and 401k, the money you put into your retirement funds, that's the tax deferred. So that means the amount you put there, you don't have to pay taxes now. Let's say you're making 100,000. In 401k, you can put up to $19,500. So if you take out, let's say $20,000 out, so you are taxed only $80,000 of your money. So rest of the $20,000 you don't pay. That money grows until you don't have to take the money. Until 59 and a half, you're not supposed to take the money. But basically, government saying, don't take that, save it. So that money growth is cumulative, and the growth is exponential, not linear growth. It's exponential growth. Money makes money. So that's the other option. And third, if you have additional money, you can invest your money into invest equity market. So the couple of things I wanted to mention. Being from India, most of our Indian origin are people from India or South Asia. The thing is, our way of saving is in gold. A lot of people save in gold. The reason is the inflation is way high because inflation is local to India, and gold is a global market. So the gold is trades in dollars. So the dollar point of view, the inflation is lower. So the value was protected in the gold. So that's the reason most of the people from India, we tend to have gold bugs. People say gold bugs. There is a reason for the reason we used to love gold. But all the developing countries, including, you take the England, Germany, France, Italy, Germany, or Japan, Australia, go all these countries, most of the people's wealth is tied to the equity market. So most people, the reason being Coca-Cola, Pepsi, there are only two companies in the world. So no other drink in the entire world. Can't you make it another drink? No, you cannot. You can, but you cannot survive because the power of the corporations, right? And same thing, like a 3M, Apple, Microsoft, Google, all those companies, they are behemoths. They're growing not only US and the entire world. So if you join in a company, you may get like a 2%, 3% raise. However, if you invest in Google or somebody else, the corporations are growing 25%. Your chances of your wealth can grow a lot faster than the inflation, a lot faster than the gold. So that's the reason most people's wealth in the Western countries tied to the equity market and bond market. The biggest market is not the stock market. The biggest market is the bond market. Bond markets are trillions of dollars. You get consistent income with the bonds, but the stocks, the only way you can beat that is investing into the stocks. That's the reason most of the Western countries, the wealth is tied to the equity market.
Okay. That's really interesting and good to know. Good information. And now I would like to ask Mr. Dake. Mr. Dake, since you have started it, it's been 6 years,
Right.
right? So I would like to ask you, as a chartered accountant, tell us a brief about your journey and how it has been till now.
Yeah. After 10th, my journey started to pursue the chartered accountancy course, right?
Okay, yeah.
After that, many of my colleague friends were started to thinking to become a engineer or doctor. It's a regular streamline.
Yes.
So I feel like that why to go in regular fields. I started to think differently, and my father, he's now retired professor from commerce background. Yeah,
Oh,
he guided me very well, and he
so the commerce was in the blood. I guess Mr. Narayan lost the connection. Arijit,
hello.
I think
Am I
he's
yeah,
back.
are
audible?
you
He's
there?
back. He's back.
You
Hello.
are audible, but your video is
Yeah,
not.
your video is
Hello.
not. Yes,
Your video.
Narayan,
Hello.
can you hear us?
Yeah. I can hear you now.
So you can
Yeah.
continue probably.
Yeah. Yeah. So yeah. So my father guided me well and told us that it was my dream that someone from our family should be at a greater level in a commerce background. So
Okay.
he gave me the option to choose a CA as a career.
Okay.
Yeah, yeah. So I thought whether I could take it or not. So he tell me, "Don't worry, I will be with you. No matters how many long it will take, you can do it." So that was a good part. He supports me well.
That's great.
But yeah, for after 10th, I took a science background actually. Yeah. 11th and 12th I did science. Purposely I did that because at my native place there was a no mathematics subject in commerce field at that 11th and 12th standards. So for chartered accountancy course, your maths should be strong. So I purposely chose science field at that
Okay.
time.
Okay.
After that, from shifting to shifting science from science
Science
to
to
commerce,
commerce.
yeah, yeah, it was very hard for me in first year of BCom. It was a very hard year for me. So I dealt with BCom somehow, and
The changes.
yeah, 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 yeah.
So that's good to
That's
know. That's good to know about Mr. Dake, and
yeah,
that's incredibly good journey from a science to a commerce, and then to do
right.
a CA.
Yeah.
It's indeed a wonderful job, and congrats to you for taking that up and providing many things to the people all over. So I would like to go over to Yogesh because I see he's sitting quietly for some time. So so let us have him for a quick question. Arpita, would you like to ask him?
Uh, yes.
Now that before you start, now that we almost asked, like by introducing him, almost talked or went through his journey. So quickly go to the next the question part of it.
To Yogesh.
Yogesh, yes.
Okay. So, well, actually, Arijit, this question would be to both of Yogesh and Narayan. So,
Okay.
I hope both will be able to answer me for this. How can you help me to better manage my cash flow?
I think Yogesh should answer this one first.
Yes, I want Yogesh to answer this. How can I manage my cash flow?
Yeah, see, when you earn some money, that is the major source of your cash flow, right? So we should have to put in place that how much is cash flow is generated, and that cash flow you are generating by your say salary, by your rental income, and so other things that you earn. So that is the source of inflow, and we should also take in consideration that what our cash flow should be placed in right things, right? That we should manage our expenses. We should what amount of the cash flow should be invested for short term, for long term,
Yes,
also
so
for
managing day-to-day expenses and
yeah.
apart from that, the savings.
Yeah, so this is the most critical part that everyone should segregate. That what should be amount from our cash flow should be diverted to investment, diverted to insurance premiums, diverted to our expenses and our loans, EMIs, and so for this we should plan accordingly for short-term goals and for long-term goals. This is the cash flow management.
Mr. Narayan, I would like to ask you the same question.
First of yeah, first of all, I would come. I would like to talk about the salaried persons. Yeah, you need to cut your expenses. You need to save at least 15% of your monthly salary. Keep aside. You can manage your regular expense through your 85% of income. Yeah, 15% will be your 10%. Out of 15%, 10% will be for your emergency funds. Like any emergency happens in your family, like some death, yeah, or some critical major medical expenses. So, and 5% will be diverted to your retirement funds, so that you will assure a very good retirement life. Yeah. So this will be the cash flow for salaried persons.
Salaried
And
person.
yeah. For business owners, I would like to say that cut your most expenses. Try to invoice. Try to get invoice financing. I don't know how much business owners know about the concept invoice financing. In that invoice financing, uh, lenders are give lenders would like to give you finance on because on based of your sales invoices. Yeah,
Okay.
yeah, so that you can have very
So
much
we
cash
need to show
flow to.
more sales or like.
No, you can manage your salaries, utility bills, or any other thing, regular expenses from this invoice financing. In India, it would be more like cash credit account. Yeah,
Okay.
the rate of interest is also low. Yeah, and you can manage your all regular expenses.
Okay, right,
Yeah,
right.
so
So
it's from.
globally, as Mr. Srini said, as Mr. Narayan said, and Yogesh said that we need to have some, security or some amount reserved with us, saving
Yeah, reserve.
for,
Yeah,
yeah, for any emergency fund we should
yeah.
have every time. Yeah.
Yes, yes.
So okay. So next, Arijit, would you like to ask?
Yeah, sure. I'm muting everyone because I'm getting too much of echo from everywhere. I don't know why. Okay, so now that you talked about the cash flow, I'd just like to know what strategies as an individual can adapt to make secure financial investment in Indian market. Now that Srini mentioned about the US market, I'd like to know about the investment in Indian market.
Yes. Uh, in Indian market, for investment strategies, you should uh, invest your money in a proper mixture, as we can see we can invest a lot in our daily expenses, like grocery, whether you all whether you buy rice uh, from your whole money. No, you will buy all groceries, right? Rice, dals, even masalas, so that like this, in investing stock market also, you can invest in a mixture, like stock, dates. You should have good and proper mixture.
जैसे हम लोग ग्रोसरी लेते हैं, ग्रोसरी में
Right,
या
right.
सब्जियों में हम जैसे एक ही सब्जी नहीं खरीदते हैं या
नहीं
सिर्फ
खाते.
दाल नहीं
Right, right.
खरीदते हैं, हम लोग अलग अलग जगह पे थोड़ा थोड़ा इन्वेस्ट करते हैं,
Yes, yes.
थोड़ी थोड़ी चीजें अलग अलग टाइप की लेते हैं,
Yeah.
ऐसे ही हमें
So that
इन्वेस्टमेंट मार्केट में भी
your
हम.
yeah. So that your whole money you should not keep at one point only,
Yeah,
and there should the risk can be divided.
yeah, yeah, yeah.
Yeah,
इस बात
yeah.
पे I have the same question for Yogesh. जैसे Arpita, you rightly said we have to have a mixture of it, and I'd like to know from Yogesh what you think about this particular question. आपका क्या राय है?
Yeah, in the context of strategies that one should make in Indian financial investments and Indian market, we should see the opportunities that are available uh, in the Indian market with respect to your US market. You can invest in US also, right? All NRIs and US and their UK market and other markets. So, with comparison to investment in Indian market, there are lots of benefit and positive points to invest in Indian market. That Indian market has a very good potential to grow over next 5 to 10 years, right? So for the securing our future with Indian markets, you can consider bonds and that fixed deposits of corporates that give good returns than bank FDs, right? And also you can see mutual funds and stocks. So you should firstly plan accordingly. Your there should be your prepared financial plan that where you need to invest in how much amount you should invest in
So,
equities.
the planning which you are saying कि we should plan accordingly. So,
That
as Mr. Narayan Dake said, and even I would like to ask you कि business person के लिए और salaried person के लिए भी planning अलग-अलग होगा क्या according to Indian market?
Yes, because the salaried person has very less sources of income, right? He know what is his income, so he should plan accordingly and very precisely. Whereas business persons has
और यहाँ
opportunities to
यहाँ मैं
generate
ये भी
more
पूछना
income.
चाहूंगी कि in business small business also counts or
Yeah.
big business. So small business में because earning is not regular. Like किसी महीने में हम लोगों को business जो small business owners हैं उनका किसी महीने में बहुत ज्यादा इनकम आता है और किसी महीने में कम इनकम आता है तो ऐसी परिस्थिति में हम कैसे इन्वेस्ट कर सकते हैं कैसे इन्वेस्ट करना चाहिए
देखिए मैडम क्या होता है कि मान लीजिए आपका जो भी बिजनेस है, यू आर जनरेटिंग income in small business also and full
यस
time business also.
बिल्कुल
Small
बिल्कुल
business we can consider a part time business, right madam?
बिल्कुल
So you
बिल्कुल
have other income flow also, right? So you have to look in the matter that the income generated from your business other than your other incomes, right, salary or anything, so you can plan accordingly what are your business requirements. If you want to grow that business gradually, then don't invest from your business to for your future. You may
ओके
source you may invest your part of salaried income for your long term, and business income should be invested for you may say if अगर आपका income रेगुलराइज होता है या 5 साल का पहले बिजनेस से कोई इनकम इन्वेस्ट मत कीजिए, पहले 5 साल का ओवरलुक कीजिए
अच्छा
किसी भी
ओके
बिजनेस
हाँ हाँ
से, एंड
और
आफ्टर
फिर
दैट
उसके बाद
you will have a roadmap what is the
या
future of your business, and that
या
you can consider to invest a part
यस यस यस
regular.
Uh, Yogesh, I'd just like to add a slight bit example in here because now that we have so many viewers who doesn't know the nitty gritty about the investment in bonds or stocks or equities, whatever. So let's say I'm a common man. I don't know anything. I just have 5 lakh rupees with me. So what would be the best scenario I would invest in
Yeah,
Indian
see,
market?
if you invest some particular amount in Indian market, yeah, as I discussed, there are lots of options, right?
So it's very specific. I'd like to know
Yeah, yeah, yeah.
these 5 lakhs.
Just
How do I share? Like, what would be my segments? Keeping the
see,
yeah.
what is the tenure of your investment. This is the most important, and what type of risk you would like to take. These are the two basic things that one should consider while investing. So I should ask you, what is the minimum tenure that you will want to invest, and how much you will want to take a risk for investment of your 5 lakhs. This is the most basic. So if you want to invest for a 1 year, 2 year period, you have very less options. You should invest in a less volatile, like you should invest in debt mutual funds. You should invest in corporate FDs. These are the best options for you. And if you want to invest 5 lakhs or give someone, then you should go for equities and golds and other.
I think
Yeah.
F&O will be future and options will be a great option for short-term investment also. Yeah, day-to-day trading. Right, Yogesh?
Yeah, F&O is more
So,
risky,
but
I should say.
day-to-day
Yeah,
trading,
yes.
day-to-day trading, I have a now that day-to-day trading, you have to monitor every day.
Yeah.
So
Right, right.
I start the morning, and then I have to go through my the portfolios before I invest in that market before the trading starts. So now I have to keep a watch on the regular movement. So for a
No,
working person, yeah.
no.
Yeah, it
In
is
my
now.
opinion, we can have a forward contract that at one point when stock goes at this price, I want to sell.
Okay.
Yeah, yeah.
Okay.
You can also do that, so
Okay,
that
so even
you will get a
in a
better
day to
price.
so let's say even in a day-to-day trading, I buy a stock which is let's say 100 rupees. It starts with that, so I can seal it at 200. But let's say if it comes down to 50 during that day, so what is the will it still be there for that day or it's gone?
No, no, it will be
That's what
there. It will be for
Arjit
forward
was
contract
saying
where
today.
when your the stock price will go up about up to 200, then only your stock will get sold.
Right,
Otherwise,
Yeah,
it would.
yeah,
right.
yeah.
That's a
Otherwise, it
very
will remain in stock.
Yeah.
that's very nice to know. And let's continue with the next question. I'm sure all the viewers are getting benefited with this kind of information. We'd like to go to Srini for our next question. Arpita, please.
Yeah. Yes. 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 Okay. So, Mr. Srini, my next question to you is: can you please explain a bit about individual retirement accounts?
Yeah, yeah. Before I jump in, can I divert for a couple of minutes?
Yes. Yes. Yes.
I'm really
Of
disturbed
course,
when
of course.
really disturbed when I heard about day trading. A stock market is not a money making machine for day trading. Day trading is I'm selling, you are making, you are buying. So your money is coming to you, and my money is going to other person. So one
Yeah.
person plus is other person gain. Same thing with the options or derivatives, and I do a lot of derivatives for the trading purpose. It's not for ordinary people. You don't want to touch them with a 10-foot full. For people.
That's what Arijit said, that we are common people, so we just
Absolutely
move
not.
about it.
Absolutely
And
not.
yeah,
Absolutely not. No, day trading, nobody can get rich like that. Not even a single person got rich by day trading or selling the options and derivatives. I don't see that. I'm really disturbed when I heard that kind of comments. But again, hey, sorry, I took a deviation for a couple of seconds.
No, absolutely, you are right, because this is a point I was concerned about, the day trading.
Yeah,
And you rightly pointed it out. Thank you, Srini.
yeah.
Let's go.
Yeah, Arpita, you said IRAs, like retirement funds, right? So anything like a retirement funds or individual stocks or individual investments, it's the time is key. If you are 25 years old, and if you are if your investment is returning 8%. Now, let's say every year investing 1,000, 1,000, 1,000. At 35, you stop it and don't do anything. By the time you turn 65, that money will be $147,000. Let's say $150,000. All you invested 10,000 and just did nothing. But wherever, let's say instead of 25, some other person started at 35, and every year is investing 1,000, 1,000, 1,000 until 65 years old, the amount would be $114,000. You see how much difference? All you did was you started early. If you are,
Agree.
if you see young crowd here, I strongly urge, put your some discretionary amount. Discretionary amount is the cash flow, what it is coming after all your expenses. I'll give you a start with a small example. When I was in Minneapolis and I was just married and my wife was there and I was the only one working there, my manager, she asked me, I was moving to Chicago, and she said, hey, are you happy with your one salary? I said, oh yeah, more than happy. You know, we're only two people. What else we do? And she said, when you go to Chicago, your wife is going to work. I said, yes. If you're happy with the one salary, stick with the one salary and rest of the salary, save it. Wow, what a wonderful suggestion she gave. So every dime you save, every dollar you save, eventually it adds up. Money grows exponentially. So if you are listening from anywhere, India or US, please keep that in mind. Start early, and that would be good. And second, coming to the stocks like large cap stocks, they grow less but low volatile. Volatile means they move less, right? Like a Walmart, the big company, right? The behemoth, and Microsoft, it's a big company. It moves a little bit, but they're stable. Those are the large cap companies. Small cap companies that just started, like a Square, Twitter, those grow like a 50-20% faster, but they also grow higher and drops really bad. So you need to have the mixture of a large cap and mid cap. But people, you're starting early. Let's say you're starting with $10,000, $20,000. It's not much. So ideally, you should start with the index fund. S&P 500 index is 500 stocks in one index. So it moves less, but historically, the returns are close to 9.5%, 9 to 10% in a year, historically, since 1929. So that's coming to that, the mixture of your assets. If you are like a 55, 60 years old, you're going to retire in 5 years. You don't want to take too much risk. In that case, you put like 50 to 60% in bond stocks and 40% into bonds. So bonds return, historically, you get like 4%, historically. But because of the interest rates are so low, you may get like 1% or 2%. But you still wanted to have that bonds, even though you're getting less return. Reason being, stock market can go up and down and it drops dead. So the good part you need to remember is, if you buy individual stocks, your risk is a lot higher. But if you buy an index fund, what happens is market drops and goes up. Let's say if the market drops really bad, people get panic and sell. That's not the way you should. You have to have a discipline. That discipline, you thick and thin. Yeah, my $10,000 become, let's say, $5,000. Like with all this mixture, with the good mixture, 60-40 or 80-20, 80% stocks and 20% bond. But you don't want to sell. Reason being, you have 1,000 shares of S&P 500 or like a 500 shares of Microsoft. It doesn't matter. Microsoft doesn't go away. Your 500 shares, still 500 shares. But at one point it's 20,000. Now it's only 10,000. Who cares? It'll come back. So that's
Will come back. Yeah.
So that's, having said that. So coming to the retirement funds, as I said, in US you can start with the IRAs. You can put up to $6,000 if you are below 50. If you are above 50, you can put up to $7,000 per year. But IRA has an income limit. The income limit is like $65,000 to $65,000 for single person and $124,000 per married people. But if your income level is a little higher, most people, once you pass 25, 30 years, then you make more money, right? In that case, you cannot put money into regular IRA and take deduction, but you can put it into Roth IRA. That Roth IRA, you put the money after tax money. The good part is, if you put money into IRA, you cannot take that money out until 59 and a half. If you ever take before 59 and a half, if the government puts you 10% penalty and you got to pay the taxes. So, but with Roth IRA, whatever you contribute, you never ever have to pay tax when you take the original amount. Let's say you put $7,000 today, next 10 years you put $70,000. Your money become $150,000 in 10 years. The original $70,000 you can take it anytime, no issues, no questions. But with the regular IRAs, After,
So, Srini, I'm just interrupting. So you said like investing 7,000 today,
yes.
let's say, and after within a span of 10 years, I invest 70,000 more. So this will double, like it will become 150. But when like if I'm taking this 7,000 out, or let's say I put 7,000 and 70,000 in the next 10 years, then when can I take this
Yeah,
amount out, complete
that's a very
amount,
good point.
77?
Ideally, you don't want to take your money you put for the retirement. You wanted to take it until once you turn 59 and a half. That's the basic rule. But some reason you have to take the money. Life happens,
Right,
right? If you have
Yeah.
money in
right, that's right.
IRA, that money, if you take it before 59 and a half, any money you take it from there will be 10% penalty, because government penalizing for not saving for long run. Government is encouraging you to save the money, right? So, but with the Roth IRA, you already paid the taxes when you invested into Roth IRA. So government says because you already paid the original amount, you can take it out. The anything addition the market gains, you cannot take it out until you're 59 and a half.
Okay.
Once
Okay.
you are 15 and a half, you can take out. However, there's one more beautiful thing with IRA. After 72, let's say you're as it just I wanted to add, let's say you have a 401k plan from your employer. Suppose you're changing a job to another company. That money you can roll it into your IRA account. All that money IRA account, after you are 72, because you're not paid taxes, right? Government says after 72, they knock your door. Hey, all these days you had good fun. You didn't pay taxes. Now you go ahead and start taking some money. Suppose if you are 70 years old, they say, okay, you're going to live 20 more years, the actuary lifetime. So you take 5% of that. So you take the 5%. If you don't want it, you don't need to spend, you put it into your investment account. That's what it is. But Roth IRA, you never have to do anything. That money is yours. After 72, you don't have to take it. Once you pass, then you pass it to your heirs. They can take it. They don't pay tax, a dime tax. That's the beauty of Roth IRA. I think within the short span, I tried to explain IRAs and 401k.
Yes, yes, yes,
Absolutely,
yes.
absolutely, you did, and it's so nice information. I am getting enriched. Probably the viewers are too. Arpita, you are also listening and keeping a note.
And we were discussing the same thing, Arijit, the other day.
Uh, just we were discussing because we were brainstorming today itself before the program, and Arpita and I was discussing about this in
Reach
fact,
out to
this
me.
particular.
Reach out to me. You shoot me an
Sure,
email. Pass my email to your viewers. I'm more
sure,
than happy to help. Just
Thank
answer
you.
sure.
Thank you
that.
so much.
Sure, sure, sure. So now that Arpita, go to the next question to Srini, then we will go to Narayan and Yogesh again.
Yes, yes, yes. So this question is, about inflation. How the inflation going to impact the financial planning?
That's right. Very, very good question. My answer is universal, not just to America, but all over US, India, Australia, whoever the listeners are. So let's say if you have like a rule of 72, like if the inflation is growing 3%, so the money, divided 72 divided by 3, like a 24 years. In 24 years, the yen, if you have $100 worth $50, only half of that. So with the 9% in inflation, within 8 years, your money will be half in India. So that's the thing that you can't skip three things, right? One, um, taxes, and two, death. The third one is inflation. Nowhere you can skip that. So you got to fight for the inflation. The way to fight the inflation is they invest in the things they go beyond inflation. Let's say being in Memphis, FedEx. If oil prices go up, what FedEx does? They do, we have the oil surcharge. They add something. So they fight with inflation with all the additional tax. So the corporations, especially stocks and bonds and all stocks, they grow they beat the inflation. Bonds never do that. You know why? Let's say you bought a house at $500,000 and you put 100,000 down payment. 400,000 you took it from the bank, and you say, how much the mortgage rate? They said 2.5. I said, can you give me 2.4? They said, okay, take it. Banks are happy if you give them 2.4%, right? You have $400,000, you're giving with the 2.4% interest rate. Tomorrow, inflation kicks in. Right now, it's 1%, 0%, 1%. Inflation, let's say, reaches 3%. Who is losing? You are bank, right? Let's say you have $100,000 more in your bank. Would you pay that 100,000? Oh, I have so much debt. Would I pay that bank? No, let them take the hit. So that's what it is. Bonds, they're not inflation proof. You are, buying by borrowing loan from bank. You are a bond issuer. Same thing. Corporations issue the bond, and they say we give you 4%. They give you 4% next 30 years. 4% is like, let's say out of thousand, you're getting $40. 30 years down the line, the $40 is the same. No, right? It's $10. The inflation is the key. So with the bonds, you're not hedging inflation. With stocks, you could hedge the inflation. So to address the question on inflation, by all means, put more, and that's the reason they say more portion to the equities, that stocks, are less portion to the bonds. Because bonds, you get guaranteed money, less volatility, but you get hit with the inflation. But that's the hedge. Let's say if tomorrow stocks drop, you have money in the bonds, and you move that money into the stocks, and then when they recover, your money is helping you. So that's the reason people put into bonds. Not just because you're getting 1%, because it's a hedge. When things go down really, really, really ugly, when you see the blood on the streets, that's the time to invest. People run away. Believe me, international paper, 2009, it was trading $4. Now it is $50. If you remember, the FedEx was trading $30 in 2009. Is FedEx is going to go away? No, people are so afraid. Now it's $290. Like, where in the world? 1,000% return in 10 years. So same thing in India. Emerging markets run faster, but the risks are higher. But here we have more transparency. We have SEC. There's so many guidelines and lots of bells and whistles. So I think, have I answered the question? I haven't.
Yes, of course.
Absolutely. And on this,
Yes.
now that you said the FedEx or whoever, about the, I was talking to Arpita just today, and that reminds me, some of the companies like the Roku,
Roku.
the last year only, it was like a rock bottom. They started with $19 or something, then went to 43. I was yesterday looking at it, it's $170. So how does this is
You're going right way.
Because you thought that it won't reach up to that level.
Yeah, that's a very good question. That's the thing. There are a lot of measures. That's the reason. If you are starting early, younger, and don't know much about investing, so by all means start with index funds, and you stick to the index. But overall index returns are 8 to 9%. 9% in United States is equivalent to 17% in India. The reason is our inflation is 1%. The inflation there is 9%. So if you get like 1% bank interest here, is 9% bank interest in India. So just don't get tempted. Oh, they get the 9%. No, the inflation is so the currency valuation drops by two things. One is the inflation, and two is the interest rates, and third, of course, the exports imports. And that's too macro level. I don't go there. But by all means, what I meant to say is, how to find the stocks. So let's say when the market's in the boom market, everything like high. Now tornado comes, turkeys fly. So that's the reason everybody is now trading on Robinhood and making money. They think they know everything. Believe me, I've been through that in 90s, and I know how hard it gets. But if you know the stocks valuation, you do that. If you don't know the stock valuation, that's where people like me, Narayan, and other financial advisors, these guys, we do analysis. Like my background is CFA. What we do is we read the 10Ks, annual statements, quarterly statements, and we also look for the price to earnings, price to cash flows, price to operating cash flow, how much free cash flow it is generating. People like me would dig so deep into each and every company and read through. Then, okay, if it is if you started trading at $10, but the book value itself $20. So if you took 3 times the book value, it should be $30 versus it's trading $10. We have a lot of measures and bells and whistles before we do pull the trigger. But if you don't know all those things, don't go by the gut feeling. Gut feeling kills you. So it's speed thrills but kills. Now,
or the rumors.
exactly. So that's the reason I highly encourage put the index funds like S&P. Most mutual funds, they don't even beat S&P 500. If they don't beat, why can't you buy index funds? But once you have like 100,000 or something like that, that's the time. Either if you have acumen to do research, do that, or there are a bunch of mutual funds or ETFs, you can buy them, or you can hire somebody like an advisor who knows what he is doing and how they are investing, tag along with them. They may charge a little bit, but you don't lose the shirt when things go wrong. But at least the pacify, you don't get scared. I have a client, and I don't want to take too much, but then I have a client.
10 o'clock.
I have a client. He went to uh, I don't want to tell how he is, and he gets panic anytime market drops. Really get panic. And one time he called me in the midnight, and the other time he called me like, he's sitting on my nerves. And I told him he's only 40 years old, and he has a ton of money, and he was working, and his wife is working, and I am managing. I know individually I picked the stocks and I created a portfolio, and I told him, Eric, you're a great guy. You're a good friend of mine, and I'm managing. I know I did all the homework before I set your portfolio. However, you went to Iraq, you went to Afghanistan, you are carrying like an AK-47s, you have a bunch of battalion fighting, you are a ferocious fighter, you're afraid of the little things like this, just because of market drop. So that kind of quiet him down. The reason I'm saying is, you may be a hero, when it comes to money, we are weak. So that's the thing. So that's the human psychology. So behavioral finance, loss aversion bias, that's what they call. You take the little bit profit, something coming little bit profit, and you sell it. And if you're losing money, you just hang on to that. So that's the loss aversion bias. We all go through the biases. We got to think outside that. Thank you. I think I took
So that's what, like we were talking about opportunity cost, Arijit. One of your friends, he didn't invest, and he just said, "Oh, I lost it," because he just saw the comparison in the market, and he just made up the mind that, "Oh, I lost it." He didn't even bought that.
That's true. That's true. Like people are afraid of a lot of things. Yeah.
Yes, true.
Thank you so much, Srini. Thank you. We will now go to Narayan and Yogesh. So, yeah, Arpita, carry on.
Okay, so my next question to Yogesh. Can you explain about FMP, fixed maturity plan? And unmute. Yeah.
I think, after you, okay. So, I think Narayan has to leave by 9 or 8:50. So, we can ask Yogesh. Let Yogesh answer this one. Then we will take up
And then we'll
Narayan
ask
because
Narayan.
he has his daughter's exam. So, yeah.
Yeah. Okay.
So I shall give you a brief explanation regarding fixed maturity plans. Fixed maturity plans are like fixed deposits, but these are invested through mutual funds. So when fixed maturity plans, you have to those are close-ended schemes. So you are given a stipulated time to enter, say maybe 10 days, 15 days NFO time. Yeah, it is given to enter in the scheme, and fixed maturity plan scheme is invested a particular portfolio of bonds, and fixed maturity plan, as you name suggests, it is given a fixed maturity, say 1 year, 2 year, 3 year, maybe up to 5 years. So the benefit of investing in fixed maturity plan is obviously tax benefit one can look in, and other is the returns. So there has a less volatility regarding to debt mutual funds in fixed maturity plan. It gives you guidance that you may achieve for 2 years, you may achieve a fixed rate of time and approximate income, that rate of interest. Say if you want to invest for 3 years fixed maturity plans, the currently it yields around 7 and 7.5%. and also that returns you get in hand. You also get a tax benefit of indexation benefit. So fixed maturity plans are a better investment opportunities compared to fixed deposits. So this we can consider this as a good investment option.
Okay, that's good. Thank you so much for this. So my next question to Mr. Narayan Dake, what strategies an individual can adopt to make secured financial investment in Indian market?
Yeah, as I rightly previously said, that you need a proper mixture of debt and equity funds. So, and it will be a good strategy for your long-term as well as short-term plans. Yeah, that's all. That's all for myself.
Okay, so the next question is, what changes could an individual make that would help him secure better finance if he is not keeping up with proper finance planning?
Changes, I would say rightly that he should cut his expenses to a minimum level and
Okay.
invest in a such a way that it will get a high returns. If you have good money and
Mhm.
you can wait for a long term period, obviously
Mhm.
you will get high returns.
Okay.
Yeah.
Okay.
We would quickly go with Narayan about the questions we have for him.
Yeah.
Yes, yes,
So,
yes.
are there any specific tax regulations that we should know about?
These are not industry specific.
Sorry, I made a mistake.
What time? Yeah, for what time you make investment and in which stock or mutual fund you will invest. These are for long term capital gain for equity shares which are for which we have paid security transaction tax. It will be a 20%, and for short term it is a 15%, and other than STT shares, it is your regular tax slabs, up to 2,50,000 it will be nil, above 2.50 to 5 lakh it is a 5%. It will go in that bracket.
Okay, that's good point to know.
Yeah.
Now that how can you just touch base us about our audience about the estate planning, the tax planning, investment planning, as well as the retirement planning. So just a brief about it.
Yeah, for estate planning, CA part is just to reduce transfer cost. Like if you are planning to transfer your estate in case of death of your father or some relatives, you need to transfer it in your blood relation only, so that you can get stamp duty exemption, and it will also does not attract income tax. So it's a part of only transfer.
Arpita, that's that's quietly in brief, but yes, I got a brief idea about it. But now that
Mhm.
we are like a crunch of
Short of
time,
time. Yeah,
so yeah, crunch
I
of
that's
would
why
time.
I cut it.
like to ask one question. You know,
Mhm.
what is the difference between roles in the roles between CA and CFA?
Yeah, CA is a more descriptive role. You can do accounting as well as auditing, also taxation, and also management consultancy. Uh, and a CFA mostly they do investment banking and portfolio management. That's
Okay.
their role is limited to that.
And I
Okay.
was discussing with Narayan as well. There is another more term is a FCA. So ACA is an Associate Chartered Accountant. When
Yeah.
what I gathered the knowledge from Narayan, and then FCA. So FCA is a fellowship in Chartered Accountancy. When we have like you are done with the 5 years of your experience, right, Narayan?
Right, right. Yes, yes.
Absolutely. So I got a bit
When
of.
you get a post qualification 5 years experience, then you will get a fellowship degree.
That's
Yeah.
wonderful
Okay.
to know.
Okay.
That,
That's great.
so now that we broadly discussed with you about the short-term and long-term investments, and now when do you need to communicate with your clients? That you also handle so many clients, or how
Yeah.
often do you need to communicate with your clients?
Yeah, fortunately, as this GST era has come, we need to keep in touch with client on monthly basis. Before that, it was like once in a year. Yeah,
So, Narayan, I keep, very, very, very much nagging him, every
yeah,
month.
yeah, 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 yeah. Arpita keeps following me every month. Yeah, yeah,
So,
right.
so I got that, that hammer was on me.
Yeah, 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 yeah. Because before 20, every month we have to comply
GST,
on monthly basis. Yeah,
monthly
GST.
basis. Yes,
Yeah.
yes, yes. That's true. That's true.
Add one more question to add in this perspective. Now
Mhm.
we are talking about the clients. So, what methods or metrics do you use to evaluate the organization progress?
Yeah, and we generally keep previous data like 2 3 years, how client is progressing, how it's his or her sale is increasing, how they are reducing their expenses, and how they are gaining more and more margin. So we, as a chartered accountant, keep these parameters in mind to assess the client.
That's wonderful to note, and I'm sure Apita, you are keeping note of all those things, and
Yes, yes.
we we definitely need the CAs,
Yes,
and
she is more
their guidance.
keen about reduction in costs. Yeah,
Every
obviously.
businessman would
Yeah,
think,
yeah.
yeah, yeah,
She
yeah.
is a good entrepreneur,
Thank
I
you.
must say.
So, so before I know you are running out of time, so we could quickly ask two more questions before we wrap up with you.
Sure, sure.
So, is the cash flow statement enough to tell whether the company is doing well?
No, as I rightly said, we compare profit and loss account as well, balance sheet as well, and cash flow as well. So these are the key documents we can discuss for 2 3 compared to for 2 3 years, so that we can get actual parameters and actual position of the any organization,
Short and sweet.
not only cash. Yeah, yeah.
So, and now just last question before I we go over to Srini and Yogesh. So, how to forecast revenues for the company?
Forecasting, I'm like to pass this question to the Yogesh.
Okay,
Yeah,
so
yeah,
take it up with Yogesh,
yeah.
and then I think anything to add, Arpita, on to Narayan?
No, I mean, it was a really great session with Narayan, and thank you for
Yeah,
your
thanks.
insightful comments and
Thanks,
answers to
thanks.
our questions, and being patient with us.
Yeah, yeah.
Thank
So
you,
thank you
Narayan.
so
Thanks.
much.
Yeah,
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 and
yeah,
it
yeah.
was a
Thanks for the
pleasure to have you
opportunity.
on our show.
Thank you so
Yeah,
much, Narayan.
yeah.
Thank you for
Thanks,
being a
thanks,
part
thanks.
for our
Yeah.
show.
Thanks,
We
thanks.
will, yeah, will be like having you again sometime when we have time more
Sure,
to
sure. No
discuss.
issue.
Thank you so much. Thank you.
Thanks.
Now, Arpita, let's go to Yogesh and Srini.
Yes,
Okay.
yes, definitely.
Thank you. Thank you, Narayan.
So the same question, Arijit, you asked to Narayan, and Narayan passed it on Yogesh.
Yeah,
So
yeah. Yeah, I can give my limited view regarding forecasting of the cash flow of any company.
Okay.
That you
Okay.
can consider the company's past cash flows that were generated from sales of the companies, or companies doing their operating and businesses. So we can prepare their cash flows, previous cash flows of the company, and on that perspective, we can prepare a forecast regarding further cash flow by putting all these generated sources of cash flows, and that that how previously they have grown, and what in the future lies, what that companies want to expand, and how it has make an expansion, that gives you the general guidelines that how can you expect the increasing cash flow of the company. And the cash flow is the you can say the main part of the accounting and assessment of the company, because it gives you the clear view that cash flow is the real figure that gives you accounting things.
Yeah. Okay. So my next question is to Srini. Um, okay. So I would like to ask you, what should the personal milestone in terms of investing for any professional, for any income group?
Can you repeat that question,
Yeah.
please?
So what should the personal milestone be in terms of investing for a professional or any income group? For any income group.
There is no such thing called milestone in my view. Investing can be done at any time, at any phase. The intention, my guess, is like for secure future. For that, that's the key to investing. So that's the time you start. As I said, the time is the essence. So the earlier you start, the better off you are. Yogesh also in the financial planning area, so we closely ally. Probably we say exactly the same things. So to keep, so you spend, if there is $1 income and you're spending 90 cents, you end up with 10 cents. You spend 10 cents, you end up with 90 cents. That's the common sense thing. In a lot of financial planning is nothing but more or less runs from common sense. So the thing is, second thing is, the biggest thing is like a discipline. The human nature is we get tempted for things, comparing with the Joneses. You bought Lexus car, I want to buy Benz car, I wanted to buy it, whatever. So the thinking is, you need to have inner compass, where I am, how much I wanted to reach, how I can compare myself to myself, not myself to next Arjit or Arpita. No, I am me. Aham Brahmasami. That's a Sanskrit saying, right? So you got to look in yourself. That's the only thing I could say.
That's wonderful. Okay. So next question for Srini. Since last 10 years, you've been managing value portfolios. So can you briefly tell us and our audience this particular segment?
Oh yeah, sure. Yeah, as I said, investing. You ask a very wonderful questions. One of them asked about the cash flow. Cash flow is, anytime you look into business, you look into a balance sheet, income statement, and cash flow. So balance sheet tells you how much assets and liabilities. How much cash I have, how much inventory I have, how much I need to pay next 1 year, how much I need to pay in the long term. After all the liabilities and expenses, that's your equity, that's the book value, right? And same thing with income. How much income how much sales I have, how much cost of goods, what's my gross margin, what my operating expenses, what is my taxes, interest, income before taxes, how much I pay taxes. Then leftover is income, right? But as far as the cash flow, there are three types. One is operating cash flow, second one is the financial cash flow, and third one is the investing cash flow. So operating cash flow is, let's say you make $100 profit. So actual true cash is not just $100. You take write-off for depreciation, cost of interest, you paid all the interest expenses. Those you don't pay taxes legally anywhere. So that you may make $100, but your operating cash flow could be $200. So when you are investing, you got to look for what's my operating cash flow. The next thing is investing capital, investing cash flow. That's like, day to day, you need to have the capital expenses. You need to have the building, you need to have the machinery. Those are the cap expenses. After operating cash flow minus, you take out the capital expenses, left over is free cash. That's the money you want to look for. How much free cash flow company is generating, how far it is growing, how fast it is growing. So that's what we do and analyze, when you are investing. Same thing, Yogesh, he looks into those kind of numbers. Based on that, you forecast and you invest into the companies. But that's the one thing I'm going way above, but average person don't need to look into those kind of things. Stick with the good investing, like indexing funds, until you reach a certain level. Let's say once you starting with the $10,000, $20,000, anything you left over with, start with indexing fund. Once you reach 100,000 or so, that's the time you start getting into investing into individual companies. Okay, is it Oracle? Is it good or not? You can do a lot of research. Before going to individual stocks, you can buy mutual funds, equity mutual funds. That's more diversified, like S&P 500. Instead of S&P 500 stocks, tech company, tech fund, tech mutual fund may have more technology companies. So those kind of things. So the value investing, what we do, as you asked in the value, that's what we look for. If something is trading at $200, like something like Tesla trading like at $400, is it worth it? You got to look into, how much cash it is generating, how much debt they have. Is it really worth paying that kind of money? Today, some IPO came, snowflakes. It's no matter what, up in the air, it's went to $200. Is it really worth it? You got to look into, is this really worth or not? How you look into the value investing is not going with the crowd. You need to look into what's the book value and cash is generating. Based on that, if the multiples for the stock is like a 10 times, 15 times is the normal market, but the stock is trading 300 times because the expected future cash is going to be skyrocket. Tesla is going to take over the entire world. Oh, we can buy
So,
it.
Srini, just to interrupt you. So, given the choice, Tesla or Amazon or Google, which one would I
I
go
would
for?
rather put Amazon and some Google, but probably not Tesla. Reason being, the amount of cash generated by the Amazon is enormous. It's like sales are close to $600 billion. So it's going to be one day beyond my Walmart. In 80s and 90s, people used to hate Walmart because they're coming and taking away small mom and pop shops. That's exactly what Amazon is doing. Anytime you see, I hate this guy, that's the place you may think investing into, those kind of things.
True.
very, very true. Very true.
So Google is one and only. Who else? Where else you Google? So we look for anytime, not only the value investing, not just these. You also look for who are the moats, who are those monopolies and duopolies. FedEx, UPS, only two companies, right? In US and in the Coca-Cola, Pepsi. You look for a duopoly. Like Microsoft is the only window operating system. Google is the only one. Tell me what is the alternate for Facebook? Tell me. Which social media? One social media. You have Instagram, owned by Facebook. WhatsApp, owned by
Owned by, yeah.
so tell
Of
me.
course.
So the companies, the governments, they go after them. But at the end of the day, you look for monopolies, not just and you look for things are cheaper, better, and look for like business strong companies. Berkshire.
Sustainability. Sustainability.
Exactly. That's the way Berkshire, Warren Buffett invested in the value investing, is by looking into those companies, great companies that are trading at the lower price with the meaningful growth. You need to look into the growth also, but you need to have the value. But we don't want to pay overpay. When I asked I go to Berkshire annual meeting, so somebody asked, how do you figure it out which is the value, which is not a value? So he said, just by looking, you can say the person is 200-pounder or 100-pound person. Look for something healthy companies. That's exactly what he said. So don't buy super bubbly companies. There are always fads there. Buy and stick to great companies and hang on to them for long run. So that is about value investing. You don't need to know cash flow statements, balance sheets, those kind of things, but look for simple, meaningful things. What's my price ratios? What's the price to earnings, price to cash flow, price to book? Is it out of norm? No, I'm not going to do. Is it within the norm? Okay, then the next step you look for what kind of competition this company has. Is it like a restaurant, next door restaurant has a bunch of companies there, so you don't need to you don't get any bang for the buck, but you look for a few companies like a simple thing. FedEx, if it is trading right now, the price earning could be 30-40, but if it drops to 20 or 15, or tomorrow market crashes and drops to 15, you just pounce on it and just grab it and hang on to that. That's exactly what happened in last market crash. But you don't wait until crashes and booms. But what you do is, if you have like a certain discipline, let's say every month I'm going to invest $1,000, take that money and put it into index or 10-15 companies, real good companies, and stick with them thick or thin. That is value investing about. There are thousands of millions of hedge funds, bunch of people, lot of rich people. They got rich with the stock market, but with the discipline. The discipline is the key. Thick or thin, just hang on to that. You count the number of shares, how much percentage of yield, dividend you are getting. That's all matters. Market goes up and down. That's not in your control. What you do control is how much you can invest, and forget it. Don't even jump into it. As long as there is no debt, they're great companies. Just hang on to that. Thank you. I think I answered your value investing question, I guess.
Absolutely. Now, before again we go back to Yogesh, I would like to ask one more question.
Wonderful.
How do you see about the cryptocurrency market now?
I don't believe it. It's like there's a lot of fads come and go. Believe me, a lot of fads. The blockchain technology is a great technology. It has a lot of future in it. There are a lot of fads come and go. That's one of the fads. Don't fall for the trap. And that's my personal opinion. I don't put a dime. And as I said, don't touch with the 10-foot pole. That's one of those things I don't touch with. Let other person make money and not me.
Okay, great to know. Arpita, unmute you also. Yogesh, I would like to know about the asset allocation from you.
Yeah. Asset allocation basically involves the dividing of your portfolio in different assets, right? So there are we can say there are different categories of asset like stocks, bonds, that you put cash or fixed deposits, and also with a part of real estate and gold. So these all assets put together in a right manner with our time horizon and risk tolerance, that we can say asset allocation strategy. So the asset allocation, we can adjust our asset allocation with our time horizon. What time we have in our investment portfolio, and how much risk we can take with our investments. So this decides how asset to be diversified, right? So we can build our portfolio like a secured portfolio, like a conservative portfolio, like a growth portfolio, and you can make it aggressive portfolio with cryptocurrencies. So So, like this, we can say that asset allocation is a very important part in our investment process. So, we should prioritize where should we want to how much time we want to invest and how much risk we can take. So, if you have a greater time horizon, say you can go for a riskier investment like equities and derivatives, and or otherwise you can put a mixture of all these assets, like we can say uh, debt investment is also carrying some risk in India, because if you want to invest in NCDs or bonds of Indian companies, there is no liquidity to in secondary market to sell in your emergency. So if you want good returns, but if you want to carry these investment till the maturity, then you can go for these bonds and NCDs for Indian investment market, right? Or otherwise you can just go to debt market, Indian debt mutual funds, that are better options for you invest with low risk, like earlier we have discussed in FMP. So I can give you an example that if you invest in a 7% fixed deposit in India and 7% interest in yielding in FMP, after 3 years with tax benefit, you can consider 6.5% returns on FMP, whereas after deducting tax, you can merely get returns of 5% in fixed deposit. So that is that same applies to debt fund also. You, debt fund gives you indexation benefit and tax benefit for holding 3 years on more. So in asset allocation, we can consider tax perspectives also, that where can we get most tax benefits, and also we can get more returns also. So asset allocation ultimately decides our rate of return to our portfolio. So we should very properly allocate the investment resources to different types of investment options. So how much you want to invest for your retirement, how much you want to invest for your child education, and also you these are the long term goals, we can say. So we can invest all these things in direct equity or equity related mutual funds also, where you can have very good returns. And also, as we all know, India is a very good emerging market in world. Also people believe in Indian economy, because the figures all and all these things are transparent, and everyone can know everything about India on internet, unlike the China, right? So India is a very good emerging market, and also we can benefit investing in India with this growing economy and growing market. So also you can consider, like Srini also know, that India is now very costliest market regarding PE ratio. But but what that indicates us that India has a growth potential also, because people are investing in the Indian market with so high valuation, because they anticipate that Indian market may grow more and perform more better to the comparative emerging markets in Russia and all other like Brazil. So ultimately what we go, that the asset allocation, we can consider that all these things attached to these are equities, stocks, bonds, gold, and real estate. So there are tax benefit to every investment in India. According to NRI, you can consult to your CA. He will guide you regarding tax benefits. And after that, we have to rebalance our portfolio also. Uh, uh, if anything goes very inflated, right, real estate price or gold price or equities, then we should also rebalance these things, and we should sell some of the things if the prices are inflated, or we should buy some of the things if the prices are gone down, like now we can consider real estate investment also. So this is the main part that asset allocation plays in everyone's investment.
Thank you, Yogesh. Thank you such for a detailed
You want to hear
information.
more?
But we would love to, but we still have
Time
we
doesn't
thought
allow.
about wrapping it up within 1 hour, then 1 hour 15 minutes. Now it's almost 1 hour 35 minutes. So this kind of discussions would go on, and would and we still have just to share with you guys, we have got several comments nice, well said, very nice, good discussion. Several people have commented, so you'll be glad to know that people are watching, and they are commenting. So it's really nice discussion going on. Now that we broadly discussed about the investment, the short term investment, long term investment, about the future, what would be the best scenario to invest with a limited fund or without the limited more bulk money. So we have discussed, we tried to cover various things in it. Now that we are almost there, so I would like to ask few questions. It is open to you both. What things we must consider before short term or a long term investment?
See, short-term and
Go
long-term
ahead.
investments, what should we should go to consider that short-term investments should be in less volatile assets, right? Because short-term investment are meant to be encashed in very short period, right? And in very short notice that we may require it for our next goal that we have decided, the purpose we have decided to use that money, right? So the short term investment should be lower volatile, less aggressive, and there should be, we should not expect more returns in short term investments, right? So short term investment have primary goal is to save the capital and have the better returns comparing to other low returns asset like fixed deposit, that everyone everywhere in the world fixed deposit are yielding lower and lower returns. So they are attracting highest tax. So avoiding that and getting more returns is the priority of everyone. But the short-term investment should not be more complicated ones. They should be simple and they should have less risk or better to no risk. So short-term also short-term is the term that we should consider in perspective of everyone's investment avenues. That when that amount shall be required, shall it be for 6 months, 1 year, 2 year, 3 years? Up to 3 years, everyone considered it is a short-term investment, because short-term investment are meant to be these times also. So, so what are the options to invest in short term? Short term, we can invest like debt mutual funds, like bonds, or like NCDs that are available in Indian market. Also, we can place the fixed deposits also in corporate fixed deposits, that are also better options available. So, going to the long-term investment, long-term investment are have more options, and that may be more complicated ones also, like alternative investment funds in India. That is the most loved part of the all asset management, because those are prepared with mixed asset allocation, like equities or private equities or share of some startup also. So this is unlisted equities. These are the part of the alternative investment funds, but they are yielding more returns also. So we should know what is the risk we are taking in our investment in long term portfolio, right? So there are also, like Srini has emphasized in index fund. Index fund also you can consider for long term with less market risk, because you don't have to choose any security particularly, or you don't have to look, because index is created by based of the securities that are available at that time. Maybe downward to 10-20 years, the script that are not performing are deleted from the index. So we don't have to care about all these things. So we can plan accordingly. uh, we can say that index fund are passive fund that give us returns with idle, no fund management and no other things, but they are more consistent and give consistent returns in regard to our economy and market. But we can also explore more options like small cap, mid caps, and like other options also, that if we have a considerable time, long time horizon, like 10 years, 15 years, then we can consider also like equities of these companies that will grow faster and give better returns to us. So like we have long term investment options also, like short term investment, but we have to choose these investment options to align with our goal of the that investment, that how much amount and when I shall require that money. This is the key for every investment. So that I shall
Thank you, Yogesh. Thank you for the
conclude
detailed.
that.
Uh, thank you so much, Arpita. Unmute. Uh, Thank you so much. And I'd like to open the same question to Srini. And before,
Oh, yeah, thank you. Actually, the answer is universal. Yogesh secondly put very well the objectives between short run and long run. I try to give the same with the US spin because the names are little different, but the concept is the same. As long as you have the short run, as I said, have everybody should have an emergency fund. As I said, like you got to have certain amount, like what I need for next 3 months or 6 months. If you are working, you're a single person, you're good to keep 3 months of 3 months of emergency fund. And if you're like two wife and kids, you have at least your family, you should have at least 6 months of funds readily available. So if you put that money into stocks, they, as I said, they fluctuate a lot. So you don't want the fluctuation. You need the money right away. So what you could do is first you start with the savings account. In US, you get 0% return, and CDs you get like a close to 1% return if you go like a 2 years and 5 years, that kind of thing. But if you go invest into online bank savings accounts like CIT, Capital One, those people, they give you close to 1%, 0.8% return. So that's not much, but at least your money is there when you need it. The next option, as Yogesh said, the bonds, like a fixed income they call in India, here too, but we call bonds, the corporate bonds and government bonds. The government bonds are 100% secure. The US debt is risk-free debt. So any country, no, only US, among all the developed countries, never defaulted the loan. So that's why it's called risk-free loan, risk-free debt. So what you could do is we could put that short-term bonds. Like reason I said short-term bonds is the bonds in the short run, they don't drop value, they don't change value. The value of the bonds or fixed income is depends on the interest rate. The longer run debt, long, like 10 years, 20 years, 30 years, they fluctuates a lot as the interest rates. Let's say if you have a 30-year bond with a zero coupon drops, you have a 30-year bond with a zero coupon. Let's say if the interest rates goes to 1% up, your portfolio drops 30%, even it is bonds. So that's called duration. That's the reason you need to have short run bonds. So you can buy individual bonds. It's expensive to buy in US. And as Yogesh said, some of the bonds you cannot sell because there is no liquidity in India. Same in US. But that's the reason you got to buy, if you are anything, you're buying bonds, you buy bond ETFs or bond funds. So those are cost little and they have a lot of liquidity. That means you can sell right away. So if you want more than 1%, you rather put money into short-term bonds. That's the short run. But if you wanted to invest in the long run, what you could do is you can put money, either index funds or you have the asset mix, like bonds and stocks. Like as I said, depends on your risk profile. If you can stomach so much risk, you can. If you are young in your time horizon, you put more into stocks. And when you come to the retirement funds and all that, because what you call is the status quo bias. If you have the 401k, all these retirement funds, what they do is people put the money in the funds in 401k and just leave it there and they don't touch it. That's the true story. What it is that called status quo bias. People are afraid to look into and change the portfolio. As you get older and older, as you said, your bond portion has to go up, the stock portion has to shrink. So that's the reason they came up with the target date funds. Suppose if you're in 2020, if you're retiring in 20 years, if you put money into 2040 retirement fund, what they do is when you're 20 years down the line, you're retiring, so they put your money 80% into stocks and 20% into bonds. As the time passes away, the bond portion grows up, the equity portion shrinks. So to avoid that status quo bias, they came up with the target date funds. So that's the reason you need to look into long-term investments once in a 6 months and see where my portfolio is performing. Is my asset mix is right or wrong? Based on that, you need to invest. And beyond that, as Yogesh said, same thing here. You can add like an alternative investment, something people like real estate investment trusts, REITs we call. Those consistently give you dividend and has the less volatility. So basically, it dampens down the volatility of your mixture of your stocks and bonds. That's the reason not only stocks and bonds, you put some money into real estate equity trusts, REITs, what we call. And then if you have a little bit more money, lot more money, then your options are very open. You can put it into private equity. So where is the biggest market in the world? All the capital comes from private equity. So people invest into the corporations, young companies. The risk is high, reward is high. And if you want to go beyond that, you can go like a hedge fund. So like, usually they expect you to invest $250,000, $500,000. It's maybe different scenario in India and other countries, but here, if you have investable assets above 500,000, and you have to be an accredited investor to invest in private equity and hedge fund. One, you have to have at least $1 million in assets, and you have to make at least $350,000 per year. So then your options are a lot more. But anyway, if you are making $350,000 a year, yeah, please drop me a message.
Thank you, Srini. Thank you.
You can reach me. They'll and Arpita and Arijit share my email address.
Thank you so much, Srini. The amount of information, the wealth of information I acquired today from you both, it's really wonderful. And not only me, there are so many viewers with us today, and probably they will be listening to your the videos later on. This is incredibly like a wonderful conversation, I'm sure, from my
And a
opinion,
very
because the
informative session we had today.
yeah, very. Arpita, would you like to ask one more question to Srini? Because now that it's almost we are close to 2 hours,
Yeah.
and
Even
the question I think because I was reading his profile and he has financial article. So how about that? Ask him that question.
Yes,
Uh,
of course. So, like, your various articles, financial articles featured at various websites and including Yahoo Finance, Street.com, Fox Business News. So, what the general financial would look for in your articles, or how are they going to be benefited from this?
That's a good question. And I'm in the financial industry. People either call me or somebody reach out to me. I was with the portfolio manager for 10 years with interactive brokers, and those they have PR. They interview me they hook me up with street.com. interview, or somebody from somehow somebody called from Wall Street Journal. Hey, we wanted to know your opinion on the future economy. I said, "Whoa, Wall Street Journal called
Wow.
me." That was my honor. So I gave like an opinion on my leading economic indicators and future forecasting about the recessions. I mentioned about leading economic indicators. That article came in 2018 December, sometime right before the market crash, right at the market crash time. So I mean, those people come and read. I mean, I used to write for Seeking Alpha, and Street.com and Fox Business News. They publish my articles from anytime I published in Seeking Alpha. Mostly I wrote like individual equities and doing the research on that, and recommending a particular reason, a company, why it is valued. And it's like I'm like a financial analyst covering a particular company. And so with my CFA background, what we do is we're good at accounting and finance, both of them, and more generic economy. So that experience helped me to do the research, even before, you don't have to be CFA or an MBA or anything. It's a common sense. Investing is all about common sense. But don't buy high fly stuff, and hang on to that good ones and go from there. Um, so yeah, but yeah, to read, to get to acquire the knowledge. Especially, I don't know much about Indian market, but if you are in North America, Wall Street Journal is a great source to read. Same thing with the best place I go, like a Bloomberg. Now they're charging a little bit, but at least you can get the essence of that. The best media for financial information is for the lower end, Yahoo Finance is a great place to start. CNBC website is good. CNBC, what they do is a lot of media, they pump and dump, and they make a lot of noise. Reason being, they want to get more people viewers. They don't care for they intentionally bring people to pump it up.
Yeah, they don't care about perfect segment,
Yeah,
one segment.
they get more viewers when there is high volatility. When market's dropping, people watch. Market is going up, they watch. Bulls make money, bears make money. Hogs get slaughtered. So that's exactly they want. They want either bull or bear. But by all means, you got to look for the objective media. Financial Times, that's a British company, but they cover US and rest of the world. That's a great place to read. And if you have kids or they're going to college or something, they get Wall Street Journal for literally no price. So pretty much, if you are paying like $200, $300 per year, they may get it for $20, $30. So by all means, that gives them good leverage. If they start reading from high school and college days, by the time they get out, they're already prepared for the market. So not just market or investing. You need to understand the general economy, and one step above is getting to know the financials, and that's the secondary. But common sense, just to stick. 90% of the wealth comes from the emotional strength. Only 10% is analysis. So a lot of people with no education makes a lot of money. Reason being, they're consistent and persistent. That's the only thing I can say.
Absolutely. That's the key, consistent and persistent. Wonderful to have you both today. Before I go to you, Arpita, just quickly, I recap a few things. Now that we promised to the audience that we would come up with one enlightening show, and this is one of the show which I feel most people all over the world would be keen to know. How and what best way I can invest and double my money. We all. So we promised and we brought the experts from the field. We had with us Srini Meka, who has put forward lot of informative informations, and now that he ended up with saying about how the kids or the younger generations should go and look out for that. So that's again a very interesting thing. Like, it's not only for the adults who is looking for it. When you are starting, you should aim for that as well. And a wealth of information we got from Yogesh Bihani. It's wonderful, informative insights on managing the wealth. about the asset allocation, about the FMP plans. Wonderful. Thank you so much. And thank you. I would like to mention Pinaki Chakraborty's name because he approached me to introduce me with Srini. So thank you,
Yes,
Pinaki.
yes, thank you, Pinaki.
And thank you, Arpita, for inviting Yogesh and Narayan to our show, so we get like a more broader of both ends, from here as well as the
From
other
India.
country. Yeah,
Yes.
from India. So it's a nice, thorough. I got very much enlightened. So I'm sure all of the people around. So
Of
over to
course.
you, Arpita, and thank you both of you. Arpita, over to you.
Yeah, thank you so much, our guest, Mr. Srini, Yogesh, and Narayan, for accepting our request. And it was our pleasure to have you on our show. And to our viewers, we are very thankful to you that you you show so much love to our show. And even today, we saw your comments. Thank you for that. And I would request you to all go to the nrbnews24.com page and like it and share more comments so we can come with more sessions like this, and we you can suggest whatever you want us to do, whatever you want us to present to you. So yeah, keep commenting, keep liking, keep showing your love, and thank you so much. So. Have a good day, India, Bangladesh, and other cities, and good night to USA people. Thank you so much. Thank you.
Thank you. It's my pleasure. Thank you.